Most people think market crashes begin with a headline. They think the story starts when a war expands, when a payroll number disappoints, when a central banker says the wrong sentence, or when a television anchor suddenly starts speaking in a lower voice. That is not usually where the real damage begins. The real damage begins earlier, deeper and colder than that. It begins when the market structure changes from human judgment to mechanical reaction. It begins when liquidity thins, when the dollar strengthens, when volatility climbs into the wrong zone, and when billions of dollars that do not think, do not hesitate, and do not care what you feel are forced to sell simply because their rules say they must. If you do not understand that, you will do what most people always do in a decline. You will think you are reacting to new information. In truth, you will be reacting to a machine sequence that was already in motion before you ever opened your phone. And once you understand that distinction, the whole market begins to look different. You stop asking the wrong question. You stop asking, what did the news say today? You start asking, what kind of money is moving? And what kind of money will be forced to act next? I have spent most of my life trying to separate price from value, noise from signal, and emotion from arithmetic. That habit served me well in markets that still had a large human element. But it matters even more now. Because when markets become saturated with mechanical strategies, the first phase of a decline often has very little to do with business value and a great deal to do with plumbing. And if you do not understand the plumbing, you will mistake a pressure event for a truth event. You will look at a falling price and assume something fundamental must have changed. Sometimes that is true. Very often, especially in a machine-driven unwind, it is not true at all. What has changed is not the long-term earning power of the business. What has changed is the path by which money is allowed to move through the system. That is the line I want to draw for you today. Because when investors tell me they are nervous about a market break, they often imagine a crowd of panicked people pushing the exit at the same time. That still happens, but today there is another layer under the crowd. There are the programs. There are the trend followers. There are the volatility, targeting funds. There are the dealers who are forced to hedge as options positioning changes. There are the mandates that sell because realized volatility rose above a threshold. There are the systems that buy the dollar because stress has appeared. There are the systems that sell equities because the dollar moved, volatility rose, and liquidity disappeared. The ordinary investor sees one thing. He sees a red screen. The market itself is experiencing something much more specific. It is experiencing a chain reaction. And chains are what matter. You never want to look at a crash as one event. You want to look at it as a sequence. The sequence matters because if you can identify where the sequence started, you have a chance of understanding where it ends. If you only focus on the middle, which is where price falls and fear surges, you almost always become the victim of it. So let me tell you the sequence the way I see it. The first piece is uncertainty, but uncertainty by itself is not enough. Markets can live with uncertainty for a long time. What markets cannot handle well is uncertainty, meeting leverage, thin liquidity, and rule-based positioning. That is when a normal pullback becomes a forced unwind. A lot of investors think machine selling is some mysterious modern bogeyman. It is not mysterious at all. It is systematic capital following instructions. A CTA does not care whether you believe in the company, whether the chairman looked confident, whether the valuation looks attractive relative to 5-year averages, or whether some commentator thinks the dip is overdone. A CTA sees trend, realized movement, and threshold levels. When the conditions are aligned one way, it buys. When the conditions are aligned the other way, it sells. And when enough money behaves that way at the same time, the market stops being an auction of opinions and starts becoming an execution engine. That distinction is everything. Because if you think you are trading against frightened people, you may assume the panic will fade as soon as the headlines calm down. But if you are trading against forced programs, the selling can continue well beyond the point where common sense says it should. The machine does not ask whether the decline is already enough. It asks whether the next rule has been triggered. That is why price can move in ugly stair steps lower. One level breaks, and one class of rules engages that creates more downside pressure, that pushes volatility higher, that activates another class of rules, that forces dealers into more hedging, that creates more downside pressure again. And before long, what began as concern has turned into mechanical acceleration. In my early years, I learned that the market is not obligated to stop where you think it should stop. That lesson becomes even harsher in a market shaped by machine rules. A stock can be cheap and still go down a great deal. An index can be reasonable and still be thrown lower if the marginal seller is not making a judgment, but fulfilling an instruction. That is why I want you to separate two very different ideas in your mind. The first idea is whether an asset is worth owning. The second is whether a forced seller is currently dominating the tape. Those are not the same question. And confusion between those questions has ruined many perfectly intelligent investors. They buy too early because they think value alone must immediately assert itself. Or they sell too late because they assume quality will protect price in the short run. Quality protects you over the long run. In the short run, structure can humiliate quality. That is one of the oldest truths in investing, and the machine era has made it even more obvious. Now let us talk about the second important piece, which is volatility. Most people treat volatility as an emotional word. They say the market is volatile when it feels dangerous. In institutional terms, volatility is not just a feeling. It is an input. It is a trigger. It is a lever inside other products. There are enormous pools of capital that promise clients some version of smoother participation. The promise sounds gentle. If things become too unstable, the allocation will be cut. If things calm down, the allocation can come back. That promise seems sensible to the person buying it. In reality, it means one thing. When volatility rises through certain zones, another set of large players must sell. Not because they changed their mind, because they sold the client a rule, and once enough capital is tied to that rule, the rule itself becomes market moving. That is the problem with a crowded insurance product. It behaves like insurance until too many people own it. Then it becomes part of the fire. You need to understand what that means in plain English. If volatility remains contained, the system can often stabilize. If volatility pushes higher and stays higher, strategies that were dormant become active, then equity exposure must be cut. Then more selling arrives, then liquidity gets even thinner. Then small trades move price more than they should. Then the next wave of fear looks justified because price action itself has become worse. The market turns reflexive. One thing causes the next thing, and the next thing strengthens the first thing. That is what terrifies ordinary investors. They feel as though the floor disappeared. What actually disappeared was not the floor. It was the balance between discretionary judgment and forced response. And in a market like that, you must not act like a tourist. You must act like an owner of capital. An owner of capital does not ask, "How do I feel about this candle today?" He asks, "Who is being forced? Who is nearly forced? What is the next threshold? And how much dry powder do I have if the machines finish their work before I finish mine?" That brings me to liquidity. Liquidity is one of those words people use lazily. They think it means whether a market is open. That is not what it means. Real liquidity means the ability to transfer risk without moving price too much. And when liquidity is thin, every forced action matters more. You can have the same amount of selling pressure in two different environments and get two completely different outcomes. In one environment, the market absorbs it. In the other, the market gaps as if someone removed the bids with a shovel. That is what thin liquidity does. It magnifies compulsion. It turns stress into acceleration. It turns ordinary defensive selling into a violent markdown. A lot of people tell themselves that if things get ugly enough, buyers will surely step in. That is sometimes true. But buyers step in more confidently when they believe the selling is discretionary. When they suspect the selling is structural and unfinished, they stand back, they wait. And their waiting is itself part of the damage, because the market does not need all buyers to disappear. It only needs enough of them to hesitate while the forced sellers keep working. Then price must fall to find a level where either fresh capital becomes braver or the forced capital finishes. This is why so many declines feel irrational in real time. They are not irrational. They are incomplete. Now we come to the dollar, which is one of the most underappreciated parts of a market decline. Most people look at the dollar only through a patriotic lens or a macro lens. They do not connect it to what happens inside risk assets when stress appears. But the dollar matters because in a global system, it is still the hinge asset for funding, safety, and relative pressure. When the dollar strengthens into stress, it often does not strengthen because the world is healthy. It strengthens because people are demanding safety, funding, and short-duration certainty. That move itself becomes part of the problem. A stronger dollar pressures financial conditions. It changes relative returns. It tends to work against the kind of relief rally people are hoping for. And if enough machine models are set to buy dollars during stress, the dollar move can help sustain the volatility move, which then sustains the equity selling move. That is why I tell people never to read one chart in isolation. A rising dollar in a fragile market is not just another line. It is a transmission channel. If it breaks upward at the wrong moment, it can help turn a rough tape into a disorderly one. That is especially true when investors are already overpositioned in the optimistic story. Markets do not usually break hardest from balanced conditions. They break hardest when too many people were leaning the same way, when expectations were comfortable, and when a certain kind of asset was being treated as if it could not have a bad quarter. That is when a pullback feels most like betrayal. The crowd was not prepared for lower prices. The machines were. If you want to survive these periods, you need one habit above all. You need to stop thinking of every price decline as a verdict on long-term value. Sometimes it is a verdict. Sometimes the market is telling you something fundamental has cracked. A business lost its moat. A balance sheet was weaker than it appeared. A growth expectation was fantasy dressed as confidence. That happens. But in broad machine-driven stress, the first phase is often different. The first phase is an inventory adjustment in fear. The market is not calmly repricing the next decade of earnings. It is flushing out the holders who cannot remain seated while the structure convulses. That is why the first rule in a machine-driven decline is not to confuse motion with meaning. The second rule is not to confuse being right with being early. I have made a great deal of money in my life by being patient, not by proving how quickly I could be correct. If you see a wonderful business and it falls to a price that looks interesting, that is not the end of your thinking. That is the beginning of your discipline. You need to ask whether the market is in a discovery phase or a force phase. If it is still in a force phase, you do not need to impress anybody by being first. You need to preserve your ability to act well. I have never believed that the point of investing was to catch the exact bottom, that ambition usually belongs to people who want applause more than returns. The point is to buy well enough, size well enough, and survive well enough that a later recovery works for you instead of merely vindicating your ego. That matters now more than ever. Because in a machine market, the last 5% down can happen in a way that feels like the first 20% down. The texture becomes deceptive. Investors see a decline and assume they are already deep into the pain. Then the next threshold breaks. Then a seller who is dormant becomes active. Then another. And suddenly what looked like exhaustion was merely the market passing from one class of forced response into the next. That is why you need a protocol, not a mood, not a hunch, a protocol. My own way of thinking in moments like this is simple. I ask 4 questions. First, what do I own that I would be happy to own if quoted prices disappeared for a year? Second, what do I own only because the line was going up? Third, how much cash or near cash do I have to turn a panic into an opportunity rather than a personal crisis? Fourth, what must happen in the market structure before I become more aggressive? Those questions are more valuable than almost any prediction because in a machine-led drawdown, certainty is usually most available precisely when it is least useful. By the time everybody knows the machines have finished, prices are already higher. By the time the easy part of the recovery has already occurred. The trick is not to forecast the exact turn. The trick is to remain solvent, emotionally stable, and intellectually honest long enough to participate when the turn finally arrives. Now let me tell you where people really destroy themselves. They destroy themselves in the middle. The very beginning of a decline often feels manageable. They still think it is a pullback. The very end often feels obvious in hindsight. They say they should have bought there. The middle is where the real damage is done. That is where people start bargaining. They buy without enough discipline. Then price falls further. They sell something good to raise comfort. They keep something bad because it is already down. They watch every tick. They become reactive. And once you become reactive in a machine market, you are no longer investing. You are donating emotional liquidity to a system that does not care. If you want to avoid that fate, you need to prepare before the tape gets uglier. If you are over-leveraged, fix that before the market fixes it for you. If you own fragile stories that require perfect conditions, understand that perfect conditions are gone. If you are hiding from arithmetic by calling yourself a long-term investor, while secretly knowing you cannot withstand another 10 or 15% down, address that dishonesty immediately. A lot of people say they have a long horizon. Very few have a structure built for one. Time horizon is not a sentence you say to yourself when the market is calm. It is the product of how you arranged your life. If you need the money soon, you do not have a long horizon. If you cannot sleep when volatility rises, your sizing is wrong. If you are counting on being emotionally better in the middle of a decline than you were in the last one, But you have not changed your process. You are relying on hope. Hope is not a strategy. Margin is, cash is, position sizing is, quality is, a written protocol is. That is what serious people use. The market does not reward intelligence consistently. It rewards preparedness. And in a machine phase, preparedness matters even more because the market can move farther and faster than human logic alone would justify. Now let us talk about buying, because there is always someone eager to say every sell-off is a gift. Sometimes it is a trap disguised as courage. The difference is not whether price is lower. The difference is whether the thing you are buying is durable and whether the selling pressure is nearer to completion than to escalation. If you buy durable assets in an environment where the forced flows are maturing, time can be kind to you. If you buy weak assets because they are down a lot, time will often expose you as a speculator who used valuation language to rationalize desperation. That is why I care so much about quality when markets get dislocated. A strong balance sheet matters more, free cash flow matters more, pricing power matters more. The ability to survive a bad year without pleading with the capital markets matters more. When money was loose and sentiment was cheerful, many businesses could pretend to be stronger than they were. Stress is an honesty machine. It reveals who needed cheap capital, who needed constant enthusiasm, who needed low rates, and who can continue compounding through a hostile climate. That is where your attention belongs. Not on what every commentator says the market might do tomorrow, on which businesses can emerge more valuable after the market has finished embarrassing the owners. When I look at periods like this, I do not dream about the fastest recovery. I think about the transfer of ownership that is taking place. Weak hands are transferring assets to stronger hands. Unplanned sellers are transferring assets to patient capital. People who needed certainty are selling to people who built room for uncertainty. That is how wealth moves in every serious correction. The machines change the speed. They do not change the principle. And because they change the speed, you must change your temperament. You cannot demand emotional comfort from a market that is dominated for a season by threshold systems. You must demand only that your process stays intact. The good news is that machine-driven phases, ugly as they are, also create information. They show you where the leverage was. They show you which sectors were overowned. They show you which narratives depended on lower rates and endless confidence. They show you which parts of the market were built on sponsorship rather than resilience. And they also show you, if you are patient, where the babies are being thrown out with the bathwater. That is where fortunes are usually built. Not in the excitement before the decline. Not in the panic at the bottom, in the disciplined accumulation that begins after structure has done most of its damage, and before comfort has returned. There is another part of this that people do not like to hear. Sometimes doing nothing is the most productive thing you can do. Not because inactivity is noble, because unnecessary activity is expensive. I have watched investors burn enormous sums, not because they misunderstood a company, but because they could not tolerate waiting through dislocation. They wanted to prove decisiveness. Markets do not pay you for decisiveness. They pay you for being right enough, sized right enough, and patient enough, a machine. Driven tape can make inactivity feel like failure. You are watching numbers move every second. It feels as though not responding means not thinking. Very often the opposite is true. The person frantically responding to every move is the one thinking least clearly. The person who has already done the hard work, arranged his liquidity, defined his buy zones, reduced his fragility, and committed to a plan is the one actually thinking. He appears passive. In truth, he is prepared. Preparedness is invisible until it is needed. Then it looks like wisdom. The last thing I want to leave you with is this. Do not let the existence of machines turn you into a fatalist. The lesson is not that markets are rigged and therefore hopeless. The lesson is that modern markets have a layer of structure you must respect. If you respect it, it can become an ally. You do not need to outguess every program. You need to understand what they are likely to do to price, how they can separate price from value for a time, and how to preserve your capital and your mind until opportunity comes into focus. That is still investing. It is simply investing in a world where some of the panic. I have never believed that the ordinary investor must know everything. He only needs to know the few things that matter most. In a market like this, those few things are clear. Know what you own, know why you own it, know what kind of decline belongs to the business, and what kind belongs to the structure. Know how much pain you can truly carry without becoming your own worst enemy. Know how much cash gives you courage rather than merely comfort. And know that when machines are driving the tape, the first job is not heroics. The first job is survival with clarity, because the investor who survives with clarity is the one who gets to be greedy later when other people are merely relieved that the pain has stopped. That is where serious compounding begins. Not when everybody feels intelligent. When patient capital finally gets to buy from forced capital at prices neither side would have accepted in calmer times. That is what I would want you to remember the next time you see a screen full of red and hear the word crash thrown around like a diagnosis. A machine wave is not the same thing as a permanent impairment. A falling price is not always a changing value. And if you can keep those distinctions clean in your mind while the tape gets noisy, you will already be behaving better than most of the market. That alone, over a lifetime, is worth a great deal of money. Because the final test is never whether you can predict the next headline. The final test is whether you can tell the difference between a market that is thinking and a market that is merely executing. If you can tell the difference, you do not have to fear every violent move. You only have to prepare for it. And prepared people over time are the ones who own more of the world.